What's happening, everybody? It's your boy Creative. Go ahead, say it with me. We are back at it again to do what? To create something great. Now, today I'm super excited what I have planned for y'all today. We're going to be dropping another episode in our Creative You series. Today, we're going to be talking about ATR or average true range. And this is a indicator that I use in many of our algo strategies. And I figured let's go ahead and break it down to the nuts and bolts so we can truly understand what it does. Here at Creative Kodr, our aim is to be able to create different algo trading projects, AI agents, and machine learning. But our Creative You series, we're going to be breaking down these indicators or different AI agents that we use so we can truly understand how they work. So let's go ahead and jump on in. So again, we're going to be going over ATR, and it's called the average true range. So let's go ahead and jump into lesson one. Lesson one is going to be the range problem, right? So currently we're watching SPY trades today, right? And it moved from low to high, but that's a lot of movement, or is that a little? How do you measure the volatility objectively, right? A simple formula that we can use is called a simple range formula. Let's start with the most basic volatility measure. So the daily range is going to be the high minus the low. In order to get the daily range, right, we're going to use the high minus the low. And this tells us how much the price moved during the day. So let's calculate it using the actual SPY data, and SPY is going to be the S&P 500, the top 500 companies within the New York Stock Exchange. And here's the past 10 days, and we're able to get the daily range, right? We're going to get the high, and we're going to subtract it from the low, and here's the range for the past 5 days. And as you can see, the highest one was about 705, and the lowest was 197. And the highest came the turn of the year. The lowest came just before the year closed out. What we discovered, the smallest range was 197. The largest range was $7.05. The average range is 497. Variability is 3.6. Difference between the high and the lows. The limitations, just what we discovered, right? Looking at the past 10 days, we see a huge variation from 197 to 705. This represents real volatility. Also notice we're only looking at the days high and low. What happened, but what happens overnight, right? What if the stock gaps up or gaps down? The simple range misses the gap, and here's how we fix it, right? Before we go into that, let's go ahead and talk about our quizzes. Let's go ahead and jump into our quiz, excuse me. The first one is going to be, my fault. The first one is going to be simple range. Simple range is going to calculate the, now for question one, simple range is calculated as what? The open minus the close. Interesting. Is it going to be the high minus the low, or is it going to be the high minus the previous close? Now for open range, remember we talked about it before, is going to be the high minus the low. Now, if a stock happened to range between $2, $8, $3, $2, and $9 over fast 5 days, the problem is its perfect consistency, too much variability, how much hard to know what's normal, or the stock is broken. That's funny. So there's a lot of variability, right? Because we have huge ranges between $2 and $9. So it's hard to define what the normal volatility was. So that's why we'll need an average in order to smooth things out. And then question three, what does simple range not capture? The intraday movements, the overnight gaps, or the trading volume? So the intraday movements is depending on the time frame that you're using, right? The overnight gaps is sounding like what's a little bit more common, what it can't capture. And then the trading volume is also depending on what indicators you use, right? So we can actually get into this gap problem that we've noticed. Let's actually go into our supplement lesson here. And here it's going to break down the gap problem that we've noticed, right? So let's go ahead and go over our gap up scenario. And this is, so breaking news, the company's breaking earnings overnight. So here's what happens, right? It opened at $100, then the high was 102. So there was a gap up of 250. And then the low was 99. Then it closed at 101.50. So the market opens at 106, right? We have a gap up of 450. Today's range was 108 to 105. So the close was 107. So here's what happens with the overnight gap for good news, right? We have here's the close. Here's what happened with the gap up, right? So we gapped up we gapped up $4.50 based off yesterday's close. Calculations using the simple range, right? The high, and we have the previous close, and then we have the previous close high, then previous close low. With the simple range, we missed the 350, almost 53% of true volatility. The can site, if we use simple range with the $3, we think that the market is calm. But with true range ATR, right, it allows us to be able to see that's 650. So we missed the 350. The stop loss would have been way too tight, and the positions would have been way too big. All right, so let's go to the monster gap scenario. Acquisition acquired, the stock explode. Then we have the yesterday's candle. The open was 50, high was 52, and then the low was 49, and then it closed at 51, right? Then we have market open. It opened at 72, right? So almost a $21 gap up. Yes, those are possible, right? So today's range was 75, 70, and 73. If we're going to look at the chart, here's what that gap up will represent. Here's where it closed yesterday. Here's where the market opened and gapped up, and here's where the closed at. So it gapped up $21. And if we're using the simple range calculation, same thing. We're missing 79% of true volatility if we're using the simple range calculation. So we get that, right? So the gap problem, in order to... All right, here we go. The stock closed at $100 yesterday, but the overnight news came out. There's a stock open at 95. It gapped down by $5. The trades between 94 and 96 during the day. The simple range says that the gap is $2, but you lost $5 overnight. The range calculation is wrong. So let's check if this happens in real SPY data. So we can see that the open, the close, and here's the gap size, right? Notice the difference that the simple range right here and that the true range, the simple range missed the gap movement while the true range captured the full volatility, including the gap. So the fix is the true range, right? To capture the gaps, we expand our calculation to include the previous close. So true range, maximum of 3 values, the high and the low. The simple range, the gap up coverage is going to be the high and previous close. Gap down coverage is going to be low in the previous close. We take the largest of the 3 to get the true volatility. Why 3 calculations? Case 1, normal day, right? There's no gap, and we're able to see the true movement. Case 2, we have a gap up, right? And we're going to use the true range because we have a gap. And then same thing for the gap down. We're going to be using the true range instead of the simple range. Here's a building true range step by step. So the first day, the high and the low only, and then the second day, now we have the previous day low and close, and we're actually able to get the true range. And you can see as it's calculated day by day. So what we just solved is the true range captures the gaps, right? Either overnight or intraday. Works for either a gap up, gap down, or no gaps, and always gives the full volatility picture. So the new problem we discovered is that true range is better, but looking at the day-to-day variation, on a day might be $2, but the next day might be $8, then $3. So these single day reading are too noisy to trade on. We need an average this over multiple days. So the true range includes the previous close because it makes the math harder. That's funny. It captures the gap movements that the simple ranges misses. Maybe. Or the previous close doesn't matter. That's interesting. So just by a simple process of elimination, we're able to see that the true range uses the previous close to capture the overnight gaps that the simple high-low would completely miss, right? So that's what we're going into here, right? Just being able to understand the weeds of it is that the ATR has 2 facets, right? It has the simple range, which is going to miss the gap ups, which we've been discussing. And then the true range has the gap movement, but it doesn't average it as much. So let's keep going. So the stock yesterday closed at $100, and then today's high was 105. The low was 103. True range is, so we're going to take the $100, right? So the stock price yesterday, so 105, subtract 103, right? And then, so true range is going to be yesterday's close versus yesterday's high. So 105, subtract 100, and then we have the $5. So we're going to have B. Calculation, because we have yesterday's close, we're going to have the stock high versus yesterday close, and then we have the true range of $5. Where simple range would have just said $2 because it's taking the high and the low, not the previous close. When there's no gap, true range equals the simple range, right? Because there's no gap to account for, 0 or the previous close. So it's going to be the true range. The noise problem, right? So completing the ATR so we can have the full picture of the average true range. Excuse me, I didn't want to cough in your ear. So we have the true range now. It captures the gap perfectly. But look at this. Day 1, day 1, 250. Day 3, 780. We have a huge spike. Day 3, 310. And then day 4, 210. Which value represents the normal volatility? We can't set a stop loss based on 1 day outlier. Let's examine the 30 days of SPY true range volatility, right? So here's the 30 days of SPY true range volatility. We see we have a couple of outliers here with the 934 and also the 766. The smallest true range is 197. The largest is $10. It rounded up. That's a 5.1 difference when you're looking at the ratio. The problem is that the day-to-day swings are too erratic. We can't use the single day to make trading decisions. The final build is to smooth this out. We need average true range over 14 days, right? This is Wilder smoothing method. The first ATR equals the simple range for the first 14. The first ATR simple average for the first 14 true ranges, and each subsequent ATR, the previous ATR times 13 plus the current ATR divided by 14. A result equals a smooth, reliable volatility measure. Step by step in order to build it. So we have the true range versus the ATR, right? So you're seeing here with the ATR, we're actually getting the actual volatility measure, the actual volatility gauge of what's going on in the market. What we've accomplished is that we've started with the simple range with being able to get just the high and the low. But the problem we found was that it missed the overnight gaps, right? Then we added the previous close. Then we got the true range, right? But the problem we found with that is that there was too much noise from day to day. So in order to get the final solution, we're adding an average of 14-day period. So now we have the average true range. So you see how we built that out. We started with the simple range. Then we got to the true range, and now we're adding the A, which is the average true range, right? And it's a smooth, reliable volatility measure. So the current SPY ATR is 577. What we've built was ATR from the ground up. Now we can, ATR tells us, now we can use ATR to tell us the normal daily movement of SPY is 577. This comes from our building blocks from setting the stop loss, or sizing up option or positions, or setting profit targets, or filtering out trades. So let's apply this tool based on what we learned. Why do we average true range over 14 periods? 14 period is a lucky number. That's funny. To smooth out the day-to-day noise and get a reliable volatility, because computers can only count to 14. That is these responses, bruh. Funny. Average true range is erratic day to day, so we need to be able to get a stable volatility measure so we can actually trade with it. ATR uses Wilder smoothing, which means a simple average of 14 days. Only the most recent matters. Weighted average that smooths gradually. So it's going to be a weighted average that smooths it out gradually. Now that we've built ATR through 3 stages, right? We had the range, the true range, or ATR. We've built ATR through 3 stages. The range, true range, ATR. We didn't start with ATR. We started with the range first, right? and then we went to true range, then ATR. All right, so this is going to be a great stopping point for us to being able to understand how ATR works, right? I didn't want to make this video too long. I want us to be able to understand how ATR works and how we can use it in order to understand the volatility of the underlying price, right? We can use ATR either as a stop loss. We can use ATR to be able to understand to size up our positions when it comes to options, right? So if you do have any questions, please let me know. It is your boy Kreative. I'll be back at it again with another episode.